A three-digit number decides whether you get a home loan, a car loan, or even a simple credit card. It decides your interest rate, your credit limit, and sometimes your entire financial future. And yet, most people have never actually seen their credit report. They've only heard myths passed down from family, friends, or random social media posts. Myths that could be quietly damaging their score right now, without them even knowing it. Today, we're breaking down exactly how your credit score really works, and busting the myths that are costing people real money. What a credit score actually is. In India, your credit score is a three-digit number ranging from 300 to 900, generated by credit bureaus like CIBIL, Experian, Equifax, and CRIF High Mark. A score above 750 is generally considered good, and it signals to lenders that you're a responsible borrower. Banks and NBFCs use this score to decide three things: whether to approve your loan, what interest rate to charge you, and how much credit to give you. The higher your score, the better your terms. Your credit report itself contains your personal details, your account history, loans, credit cards, EMIs, your payment history, and a record of every time someone checked your credit file. Now let's get into what actually moves this number, because most of what people believe is wrong. Myth number 1. Checking your own score hurts it. This is probably the most common fear out there. People avoid checking their own credit score because they believe it will bring the number down. This is completely false. When you check your own score, it's called a soft inquiry, and it has zero impact on your credit score. You can check it as many times as you want, on CIBIL's website or through banking apps, without any penalty. What actually causes a small, temporary dip is a hard inquiry. That's when a lender pulls your report because you've formally applied for a loan or credit card. Even then, the drop is usually small, around 5 to 10 points, and it recovers over time. Check your score monthly. It's free, and it helps you catch errors early. Myth number 2. Closing old credit cards improves your score. A lot of people think that closing and used credit cards makes them look more responsible to lenders. In most cases, it actually does the opposite. Here's why. Let's say you have 2 credit cards with a combined limit of 2 lakh rupees, and you're using 30,000 of it. Your credit utilization ratio, the percentage of available credit you're using, is 15%, which is considered healthy. Now, if you close one card with a 1 lakh rupee limit, your total available credit drops to 1 lakh. That same 30,000 outstanding now makes your utilization ratio jump to 30%, right at the edge of what's considered risky. Closing an old card also shortens your average credit history length, which is another factor lenders look at. A longer credit history generally works in your favor. Keep old cards open even if you rarely use them. Just make small purchases occasionally and pay them off in full to keep the account active. Myth number 3. Your income and savings affect your score. Many people assume that a high salary or a fat savings account automatically means a high credit score. It doesn't. Your credit score only measures your credit behavior, how you borrow and repay, not how much you earn or save. Your income, your bank balance, your debit card usage, your address, and even your marital status have no direct impact on the number itself. That means someone earning a modest salary but paying every EMI on time can have a better credit score than someone earning lakhs per month who occasionally misses payments. That said, income still matters for loan approval, just not for the score itself. Banks look at your income, employment stability, and existing debt separately, alongside your credit score, before approving a loan. A high salary doesn't protect your score. Only consistent, on-time repayment does. What actually moves the needle? So what really determines your credit score? There are 5 core factors. Payment history carries the most weight by far. A single missed EMI, even on something as small as a 10,000 rupee loan, can hurt your score more than almost anything else. And that mark can stay on your report for up to 7 years, though its impact fades over time with good behavior afterward. Credit utilization ratio comes next. How much of your available credit you're actually using. Keeping it under 30% is the general rule of thumb. Length of credit history. The longer your accounts have been open and well managed, the better. Credit mix. Having a healthy combination of secured loans, like a car or home loan, and unsecured credit, like credit cards, shows lenders you can handle different types of debt. And finally, new credit inquiries. Applying for too many loans or cards in a short span signals risk to lenders. A common rule some experts follow is limiting new card applications to about 2 in 30 days, 3 in a year, and 4 in 2 years. The guarantor trap. Here's something people rarely think about until it's too late. If you agree to be a guarantor on someone else's loan, that loan shows up on your credit profile too. If the borrower defaults, it directly affects your score and your own ability to borrow in the future. So before signing as a guarantor for a friend or relative, understand that you're not just vouching for them. You're tying your own credit health to their repayment behavior. How to actually fix a low score. If your score isn't where you want it to be, here's what genuinely works, based on how these factors are weighted. Step 1. Pay every EMI and credit card bill on time, every time. This alone carries the most weight. Step 2. Keep your credit utilization below 30% of your total limit across all cards. Step 3. Avoid applying for multiple loans or cards in quick succession. Step 4. Keep older accounts open and in good standing rather than closing them. Step 5. Check your credit report regularly, not just your score, but the full report, and dispute any errors you find directly through the Bureau's online resolution process. Report errors are more common than people realize, and they can quietly drag your score down for reasons that have nothing to do with your actual behavior. None of this happens overnight. Recovering from a missed payment or building a strong score from scratch typically takes several months of consistent, disciplined repayment, but the earlier you start, the faster it compounds in your favor. Your credit score isn't some mysterious number controlled by a bank's secret formula. It's a direct reflection of your financial habits, built quietly month after month, through the choices you make. The myths cost people real opportunities. Rejected loans, higher interest rates, smaller credit limits. But now you know what actually matters. Pay on time, keep your utilization low, and let your credit history do the work for you.